The price signal that should not exist in a functioning global commodity market. Prices do not drift far apart for long, especially not for a metal as standardized, as liquid, and as globally traded as silver. When such a divergence appears and persists, it is not a curiosity, it is a signal. And when that signal stretches into tens of dollars per ounce between major markets, it is no longer a pricing issue, it is a structural one. Silver is not an obscure asset. It is mined on every continent, consumed by industry worldwide, traded through some of the largest financial exchanges on Earth, and embedded in supply chains that stretch from defense manufacturing to energy infrastructure. Under normal conditions, if silver were meaningfully cheaper in one market than another, traders would buy it where it is cheap, sell it where it is expensive, and the gap would close. This process, known as arbitrage, is not a theoretical concept. It is one of the basic mechanisms that keeps global markets coherent. And yet, the current environment shows something that should not exist: a large and persistent gap between the price of silver in Western markets and the price being paid in China. On one side of the world, silver is priced through the familiar Western financial infrastructure: futures exchanges, derivative markets, and cash-settled contracts. On the other, it is being bought, stored, and consumed as a physical, industrial, and strategic material at a materially higher price. This is not a temporary shipping issue. It is not a tax anomaly. And it is not a speculative spike in a thin market. It is a symptom of a deeper fracture in how price itself is being formed. In theory, the price of silver is the price of silver. In practice, there are now two silvers. There is paper silver, the financial instrument traded in enormous volume in New York and London, and there is physical silver, the metal that must actually be delivered, stored, refined, and used. For decades, the market has treated these two as interchangeable. The current divergence suggests they are no longer being valued the same way. To understand why this matters, one must first understand what price discovery is supposed to represent. In a healthy market, price is the outcome of countless independent decisions by buyers and sellers, reflecting real supply, real demand, and real constraints. When price works, it is not an opinion. It is information. But the silver market, like many modern commodity markets, no longer operates primarily on physical exchange. The overwhelming majority of trading volume consists of contracts that never result in delivery. They are rolled, netted, closed, or cash settled. The system works as long as almost no one asks for the metal. For years, this structure created the appearance of deep liquidity and stable pricing. It also created something else, a pricing mechanism increasingly detached from the physical world. The Western price of silver is, in effect, the price of financial exposure to silver. The Eastern price is increasingly the price of silver itself. Under normal circumstances, this distinction would not matter. As long as physical supply is abundant relative to demand, and as long as confidence in the delivery system remains intact, paper and physical prices can move together. The current divergence suggests that at least one of those conditions is no longer holding. When a buyer in China is willing to pay substantially more for the same ounce of metal, it implies that access, certainty of delivery, or future availability is being valued more than the nominal global price. In other words, the price is no longer just about what silver is worth today. It is about what silver might be worth, or might not be available, tomorrow. This is the point where price stops being a quote and starts being a warning. The standard explanation for any price dislocation is that it will correct. Either metal will flow from where it is cheap to where it is expensive, or demand will fall, or supply will rise. But that logic assumes that the market is truly one market. It assumes that silver in a vault in the West is as available, as deliverable, and as free to move as the contract representing it. That assumption is now in question. If arbitrage were functioning normally, this gap would not persist. The fact that it does suggests frictions that are not visible on a price chart. Constraints on physical movement, constraints on inventories, or constraints inside the financial plumbing of the market itself. It also suggests something more uncomfortable. It suggests that the Western price may no longer be the clearing price for the physical world. It may simply be the clearing price for the financial system trading claims on metal. This is not a story about speculation. It is not a story about a temporary squeeze. It is a story about the credibility of the mechanism that sets the price of a strategic industrial metal. When price discovery breaks, it does not announce itself with a press release. It announces itself with anomalies that are explained away, until they can no longer be. The silver divergence is one of those anomalies, and it is pointing to a market structure under stress where confidence, not metal, is doing most of the work. Part 1 ends with a simple but unsettling conclusion. When a global commodity begins to trade as two different assets in two different financial realities, the problem is not the price. The problem is the system that produces it. To understand why silver can now trade at meaningfully different prices in different parts of the world, it is necessary to understand how its pricing system was constructed in the first place. The modern silver market is not primarily a market for metal. It is a market for contracts. This did not happen by accident. It was the result of decades of financial evolution in which commodities were gradually transformed from physical goods into financial instruments. Futures markets were originally created for practical reasons. They allowed miners, refiners, and industrial users to lock in prices, reduce uncertainty, and plan production. In that earlier model, the contract was a tool that served the physical market. Over time, that relationship reversed. As financial institutions grew more dominant in commodity trading, futures and derivatives became less about facilitating delivery and more about providing liquidity, leverage, and trading opportunities. The volume of contracts grew far beyond the volume of metal that could realistically be delivered. This was not hidden. It was considered a feature of a mature financial market. In the silver market, this led to a structure in which claims on silver multiplied far faster than physical inventories. For every ounce of silver that sits in a vault, there are many more ounces that exist only as promises on balance sheets. The exact ratio changes over time and across exchanges, but the principle is constant. The market is built on the assumptions that almost no one will ask for the metal. This assumption is not reckless in a narrow technical sense. In most financial markets, it is exactly how leverage works. Banks do not keep enough cash to satisfy every depositor at once. Exchanges do not keep enough metal to satisfy every contract at once. The system functions because behavior is predictable and confidence is stable. But this also means the price is not set by the marginal buyer of physical silver. It is set by the marginal trader of paper exposure. The implications of this are subtle but profound. When the dominant trading activity is in contracts that never result in delivery, the price increasingly reflects positioning, hedging, and financial flows rather than immediate physical scarcity or abundance. The market becomes extremely efficient at pricing money, but less sensitive to pricing material. Large financial institutions, particularly bullion banks and market makers, play a central role in this structure. They provide liquidity by standing between buyers and sellers, by issuing and absorbing contracts, and by managing their exposure through complex books of derivatives. This is not a conspiracy. It is how modern markets are engineered to function at scale. But it does create a system where the apparent supply of silver, as seen through the contract market, is effectively elastic. If demand for exposure rises, more contracts can be created. If demand falls, they can be closed. The constraint is not how much metal exists in the ground or in vaults. The constraint is balance sheet capacity and risk tolerance. As long as most participants are content to settle in cash, this elasticity is invisible. The system only becomes rigid when a critical mass of participants insists on delivery. At that point, the difference between a claim on silver and silver itself stops being theoretical. For years, the stability of this structure rested on two quiet assumptions. First, that inventories, while not sufficient to cover all contracts, would always be sufficient to cover the small fraction that actually demanded metal. Second, that in any stress scenario, participants would prefer cash settlement to physical delivery. These assumptions are not written into marketing brochures. They are written into the design of the system. This is what can be called confidence-based pricing. The market does not price silver based on how much metal exists relative to how many claims exist. It prices silver based on the belief that this mismatch will never be tested in a serious way. This belief has been self-reinforcing. Because delivery stress has been rare, participants have learned to ignore it. Because participants ignore it, leverage can grow. Because leverage can grow, the paper market becomes even more dominant in setting price. Over time, this creates a widening gap between the financial representation of the market and the physical reality beneath it. The price looks stable. The structure becomes fragile. It is important to be precise here. This system was not built to deceive. It was built to maximize liquidity, minimize friction, and allow global capital to interact with commodities efficiently. By those measures, it has been extremely successful. But efficiency in trading is not the same as resilience in supply. A system optimized for smooth financial flow is, by definition, less prepared for situations in which many participants want the same scarce thing at the same time. This is the hidden trade-off inside the modern silver market. It works beautifully when silver is treated as a financial asset. It becomes stressed when silver is treated as a strategic material. The current divergence between Western and Eastern prices suggests that this trade-off is no longer abstract. It suggests that somewhere in the system, demand is shifting from exposure to possession. And that is the one shift this structure is least equipped to handle. Part 2 ends with a critical warning. A market built on the assumption that delivery does not matter can function for a very long time. But it cannot function forever if delivery suddenly becomes the point. Have you ever noticed how major changes rarely start where you expect them? They begin at the edges, in places with different rules and priorities, revealing cracks the mainstream system can't see. Right now, this is happening in the silver market. The edge is clearly in the east. There's a growing price gap between Western and Asian silver markets, and it's not a mistake. It's a sign that the two sides are no longer playing the same game. In the West, silver is mostly a financial plaything. It's something to trade, hedge, and speculate on. It's often held through paper contracts, not physical bars. Here, liquidity and flexibility are king. But in Asia, particularly in China, the perspective is shifting. Silver is being treated as a strategic material, essential for national security and industrial might. This fundamental difference changes everything. China isn't just a small player, it's a global giant in the silver market. It's a top producer, a massive consumer, and a central hub for manufacturing. Think about it. Silver is crucial for solar panels, electronics, medical gear, advanced batteries, and even military hardware. For these applications, a paper promise is worthless. A factory can't run on a contract, needs real physical metal. Recognizing this, China has spent the last decade building commodity markets, like the Shanghai Gold Exchange, that prioritize physical settlement. Their goal isn't just to maximize trading volume like Western exchanges, it's to secure access, control, and a reliable supply of the actual material. In this kind of system, price isn't just a number on a screen, it's a signal of what truly matters. So when you see buyers in Shanghai paying a premium over the London or New York price, it's not wild speculation. They're expressing a deep-seated preference for certainty. They're saying that a guaranteed ounce of silver in their hand today is worth far more than the promise of a cheaper ounce tomorrow. This isn't just a fleeting trend. Several powerful long-term forces are pushing in the same direction. First, industrial demand for silver is exploding in sectors that define our future. The global shift to electrification, solar energy, data centers, and advanced electronics isn't a fad. It's a multi-decade transformation. All of these are incredibly silver-intensive, and for many uses, there's no good substitute. Second, governments worldwide are starting to view critical materials like silver as matters of national security, not just commercial goods. This means they're stockpiling reserves and making long-term supply deals. Their buying behavior is no longer driven by getting the lowest price, but by ensuring they don't run out. Availability has become more important than cost. Third, our increasingly fractured geopolitical world has turned global supply chains from a source of efficiency into a major strategic vulnerability. Suddenly, having your supply chain closer to home or under friendly control matters more than saving a few pennies on shipping. All these trends point to one thing: a world with more buyers who demand physical metal and fewer who are content with just paper exposure. This is where the Western financial system, with its massive paper market, starts to run into trouble. As physical silver gets pulled out of global vaults and shipped east, it doesn't come from everywhere equally. It gets drained from the places where it's easiest to buy and export. Over time, this quietly empties the reserves that the paper market depends on to function smoothly. The paper market can keep humming along, trading huge volumes of contracts, even as the physical metal supporting it gets thinner and thinner. There are no immediate alarms. The screens still light up and the trades still clear. But the system's ability to handle a shock is shrinking by the day. China's willingness to pay more for physical silver is a powerful signal. It tells us that for major global players, the old rules no longer apply. They're not optimizing for financial efficiency anymore. They're optimizing for material security. This is part of a much bigger pattern we see across energy, food, and other metals, a move away from just-in-time global supply chains toward more controlled regional systems. And let's not forget the monetary angle. For countries looking to reduce their dependence on the US dollar and the Western financial system, holding real physical assets is a strategic imperative. You can't sanction a bar of silver, you can't freeze it in a bank account or devalue it with a keystroke. It's an asset that isn't someone else's liability. The market is always set at the margin, and right now, the motivations for owning silver are fundamentally shifting at that margin. The logic of the paper market, built on leverage and trust, is becoming incompatible with the logic of the physical market, which is built on control and certainty. For now, they coexist, but they cannot share the same price forever. The divergence we're seeing isn't about speculation. It's about a strategic redefinition of what silver is for, and when a market's very purpose changes, its structure must eventually change with it. What breaks first? The price, the exchange, or the currency? Once a market begins to operate under two incompatible logics, it is only a matter of time before the contradiction forces a resolution. The silver market is now approaching that point. The question is no longer whether the divergence between paper and physical will close, but how. There are only a few ways such a system can rebalance, and none of them are comfortable. The first possibility is the most straightforward in theory and the most disruptive in practice. The Western paper price rises sharply to meet the physical price. In this scenario, the financial markets would be forced to acknowledge that the previous price was not clearing real-world demand. A rapid repricing would not be the result of enthusiasm. It would be the result of necessity. Such a move would not occur in isolation. Silver is embedded in industrial cost structures and investment portfolios, and in the balance sheets of institutions that use it as collateral or as part of complex hedging strategies. A disorderly upward repricing would ripple through multiple layers of the financial system. For industrial users, it would mean sudden cost inflation. For financial institutions, it would mean stress in derivative books that were built on the assumption of gradual, manageable price movement. From a policy perspective, this is the least attractive outcome because it is visible, destabilizing, and politically difficult to explain. The second possibility is quieter but more corrosive, a permanent decoupling between paper and physical markets. In this world, the Western financial price continues to exist, but it becomes increasingly irrelevant for those who actually need metal. Physical markets begin to clear at their own levels through bilateral contracts, regional exchanges, and off-screen arrangements. This is not unprecedented. In times of stress, markets often fragment. The official price remains on the books, while the real price is discovered elsewhere. The danger here is not volatility, it is loss of credibility. Once a benchmark price is no longer trusted by a significant portion of the market, it stops functioning as a coordinating signal. Hedging becomes less effective, long-term planning becomes more difficult, the market becomes less transparent and more political. The third possibility is the most abrupt, a delivery or confidence crisis inside one of the major Western exchanges. In such a scenario, the problem does not begin with price. It begins with settlement. A surge in delivery requests, or a sudden withdrawal of available inventories, exposes the gap between outstanding claims and available metal. The exchange or its participants are then forced to choose between changing the rules or admitting that the system cannot perform as advertised. Rule changes can take many forms: position limits, forced cash settlement, delays, or emergency measures, framed as stability protections, are all tools that have been used in various markets and eras. They may prevent immediate collapse, but they do so at the cost of trust. Once participants learn that in a crisis, a physical contract is only conditionally physical, the psychological structure of the market changes permanently. These three outcomes are not mutually exclusive. Elements of all three could appear in sequence or in combination. What is important is that none of them are merely about silver. Silver sits at an uncomfortable intersection. It is both a monetary metal and an industrial input. It is small enough to be cornered or stressed, but large enough to matter systemically. It is deeply embedded in the financial derivatives world, but also irreplaceable in critical technologies. That makes it a kind of stress sensor for the broader monetary and financial architecture. If the system cannot reliably price and deliver something as fundamental as silver, it raises uncomfortable questions about other markets that are even more abstracted from physical reality. There is also a currency dimension to this. Commodity pricing, especially in the West, is deeply intertwined with the credibility of the financial system and the currency it operates in. If a growing share of global trade begins to treat Western benchmark prices as optional or begins to prefer bilateral and regional pricing mechanisms, this is not just a market technicality. It is a slow erosion of monetary influence. This does not happen overnight. It happens through a series of practical decisions made by engineers, procurement officers, and risk managers who are simply trying to ensure supply. But over time, these decisions accumulate into a structural shift. From the perspective of policymakers and large institutions, the temptation will be to treat any silver market stress as an isolated problem, a niche market, a technical glitch. That is how systemic problems usually begin, small enough to ignore and awkward enough to postpone. The deeper issue is not whether silver will be expensive or cheap. It is whether the current financial architecture can continue to act as the unquestioned referee between paper claims and physical reality. Part 4 ends with a final warning. When trust in price discovery and settlement mechanisms is damaged, it does not fail gradually. It fails in steps that seem manageable until one day the system discovers that it has been managing the wrong problem.